All right, let's get started here. Looks like the class has grown since last week. Did I miss something last week, or did you guys just take an extra break? Okay. Anybody have trouble accessing Connect? No? Okay. Yes. Well, I mean, you just haven't done it yet? Yeah. Okay. You should still, I mean, the first due date's not till Sunday, so timing-wise, that's not an issue. I more just mean, has anybody tried to get in and not been able to? Okay. If you've had me before, this is the first semester that I'm using pretty much Connect for everything that has points tied to it. So obviously that would be a very important thing to have if you want to get the points. So today is going to be a pretty brief introduction to auditing, assurance, attestation. Kind of just the nature of not only the class, but the profession of being an auditor. Obviously, most of y'all, if you are accounting majors and following the standard pathway for the accounting major or concentration, then this is your last semester before theoretically you would go out and start working. Right? So many of you, after this semester, if you enter the accounting work field, many of the smaller firms do pretty much everything. So if you go work at a small firm, you will do audit, tax, I mean, pretty much whatever the firm does, you will do as well. So very many of you could start, if you haven't already in internship experience, could start, within the next 6 months actually working on real audits. And hopefully, at least, we'll have an idea of the process that goes into it, the mindset that's involved. Obviously, the managing of an audit and kind of the top level responsibility for it is, of course, going to be handled by people with much more experience than you all. But even very junior accounting people will play an active role in the audits. Okay. So, especially with respect to your other accounting courses, your book stresses that auditing is kind of a different beast than some of these other accounting courses. So it's not just going to be, okay, memorize these rules, how you record whatever event, how did that happen? As long as you know the rule of how to record the events, you're fine, right, in most accounting classes. Auditing is different because, the information that the underlying information that you're trying to give assurance of, obviously all of that information is accounting information, right? So you have to know how the people who got that accounting information, the financial statements, you have to know all of the accounting that goes into correctly doing all of that accounting work. But in addition to that, the actual art of auditing is much more analytical and logical, right? Because very similar to like maybe an attorney or a detective, or you can imagine scenarios more like that, where you're kind of pitting your logic and analytical skills against either somebody else as your adversary in the case of like a courtroom, or in this case, you're kind of pitting your analytical and logical skills against, possible negative financial outcomes. So you're trying to use all of your kind of common sense brain skills combined with your knowledge of accounting to catch any irregularities that you see in financial statements, basically. Okay? So, long story short, the way that you go about learning this material and studying for this class, for the audit section of the CPA, and then ultimately once you get out in there and start working, you're going to have to take maybe a slightly different approach to studying through this stuff. So real quickly before I move on there, let me pause and just say that in my opinion, the audit section of the CPA exam is the hardest section. It's one of the shortest, but it is, or at least for me, was the hardest section. So while I don't disagree, this is a slide made by your book, I don't disagree with that sentiment, but you'll notice as we go through this stuff, and have any of you started studying for the CPA exam yet? Even looked at an audit study book for the CPA? Okay. Once you get into that phase, which, you know, for many of you will maybe be next year or the following year if you go to grad school maybe, but once you get into that phase, you'll see quickly that what they can actually test for on the CPA exam in terms of audit material is somewhat limited just because of the nature of the exam itself. So what it actually becomes when you're sitting for the CPA is a whole lot of not this, but just straight memorization. In fact, audit is probably the class in accounting that requires you to memorize the most material. I'm not saying I personally am going to require you to memorize a lot of material, but if you want to succeed on the audit section of the CPA exam, well, I guess there's no way, or in my mind, to succeed on the audit exam without just being able to memorize some of these procedures. Okay, so basically, what goes into the various steps of the audit procedures, you know, the components of the various types of audit letters. There's, you know, it's been a while since I actually took the CPA exam, but from what I remember of it, all I remember from audit is memorizing stuff. Okay, so as we're learning, the reason I bring this up is because obviously just straight memorization doesn't really kind of jive with this slide. We're trying to say here with this slide, hey, you can't just memorize how to do this stuff. You actually have to put your thinking cap on and think about some of this stuff, because when you actually get out there and are trying to do audits, if you actually want the audit to mean something and you're trying to do a good job, that's when these skills come into being, right? So I guess the point your textbook authors are making is the practice of auditing requires a whole lot of this, analytical and thinking skills, logic. Passing the CPA and ultimately passing this class doesn't really, you know, if you're trying to do the minimum to pass, you might not think to think about things analytically and logically as we're going through the material. But if you actually are trying to get out there and be an auditor someday, or at least have that skill set, then as we go through the material, instead of just focusing on trying to memorize the stuff that's going to allow you to pass the CPA exam, when we cover a specific audit plan or roadmap to an audit, or just any individual scenario, you should really stop and think about what is actually going on and just try to put a little logic into it. This is basically just saying, hey, there's a big demand for auditors and it's not going anywhere. It's just getting bigger. Okay, obviously if you are an accounting major, this is good news to you. If you're not yet, or you're thinking about being one, perhaps this is some motivation for you. But even though accounting and auditing has kind of been around for, essentially, I think the first sign of it was in ancient Greece, so a long time, the proliferation of accountants and auditors and the profession in the way that we know it today has really come about in the last couple of hundred years. And so your book talks a little bit about why do we need auditors, okay? If you haven't read the chapter yet, this is an example I read in the chapter that I actually hadn't seen before that I like a lot. Anybody bought a house in here before? Okay, y'all are young. It's fair. When you go to buy a house, anybody here feel like they're like a real solid building professional? expert on all things house related. So that if I'm buying a house, I could go and be like, Vasily, you can come inspect my house for me, right? You got the expertise in your... Yeah, you do? Okay, cool. Well, assuming that I want more than a tiny bit of experience, expertise in inspecting my house, and based on the question I just asked to the class, instead of looking to my students here, where might I go to find someone to inspect my house if I want a better answer than just some experience or some expertise? Who might be able to provide me some assurance on what I'm buying if I am going out to buy a house? A contractor might. There's actually a profession called building inspectors, right? Who will go out and, you will oftentimes be required to have a building inspector come out. The bank that you're getting your mortgage from will say, hey, yeah, we'll loan you this money because it looks like this house is worth it, but before we give you the loan, we want this third party, this expert, to come take a look at the property and agree and give his stamp or her stamp of approval on all of the stuff that you've given me in this loan documentation, right? So home inspector, or really anyone who provides you some measure of, or some additional measure of trust than you used to have in what you're buying, is an example of why auditors exist. Because essentially what an auditor does is, an auditor comes in any situation, whether we're talking about financial statements or any type of audit, comes in, and most of the time it's going to be in a scenario where you have some type of manager-agent or principal-agent relationship, where you essentially have a number of different actors involved in something, and each individual actor has their own motives for doing things. Okay, so with the example of managers and stockholders, okay. If you think of a publicly traded company, what that means is it's owned by shareholders, right? So each person that goes out and buys stock, that's the owner of the company. So when you talk about CEOs or other managers within the company, those people are actually working for the stockholders, right? Because ultimately the owners are who tell the managers when they're going to have their job or not, right? But oftentimes the managers, the people that are actually doing the day-to-day operations of the company, they have different motives for what they do compared to the stockholders. So imagine you guys all own stock in the company, and what do you want that stock to do? Go up or down in value? Up, right? Okay. Why? Because you want, as an owner of the company, what do you desire for the company to do? Succeed, right? Because you invested in the company, you want a return on your investment, so you want it to succeed. Well, if you're the manager of the company, ultimately, what do you want? As an individual human, what is your top priority? Is it the money that goes into the shareholders' pockets, or is it the money that goes into your own pocket?
Your bonus.
Generally, it's going to be your own pocket, right? This is what we call the agency problem. Basically means, hey, it's very difficult to design, and I'm talking a little bit in terms of kind of some economic concepts, but it's difficult to design a system of rewards, a reward system that serves to give the managers an adequate incentive to do what they need to do, and also is totally up to snuff with what the stockholders want. Okay, so what these stockholders could do is they can hire an auditor to come in and say, hey, we want you to look at what this manager has been doing and tell me if what they have presented as the financial statements, is that accurate? Okay? Does that accurately depict what's going on? So that, because obviously, if I just ask my managers what's going on, what are they going to tell me? Everything's great, right? As long as I'm getting my money, everything's great. I don't really care about it, but it's great as long as I'm getting paid. Right? So because we have this kind of disjointed incentive system where the managers are kind of out for their, I mean, it's just human nature that people generally look out for their own interests first, right? So managers are looking out for their interests, stockholders are looking out for their interests, and the interests don't always match, okay? So this gives us an opportunity to have a third party come in here and check out what's been going on and give an opinion about whether this, whatever they say is going on is accurately going on like they say, right? So let's say as a stockholder, I want that extra, added assurance of what's going on here, but I don't want to pay a lot of money for it. So I'm going to go hire a homeless person, get them off the street, and have them come in here and check this out, right? Low cost, I'm doing public service, everything's good, right? You guys trust a homeless person's opinion, and I have nothing against homeless people. There are probably some CPAs out there that are homeless. So, do you trust this random homeless person's opinion on what's been going on in your company? Why?
They're not licensed.
Well, they're not licensed, they're not, why would you trust them? Or what reason have they given you to trust them? Right? When we're talking about money, the attitude should generally be lack of trust unless someone gives you a reason to trust them, right? So, this whole, solving the problem of the agency issues, that only works in so much as whoever needs this extra amount of trust gets it from the third party. So that enter CPAs, who are auditors, they come in and the public, I don't know, Wade, are you the one that said they weren't licensed?
Yeah.
So the public likes to see a license. They like to see that you've gone through this big process. And so everything that's tied to the CPA exam, all of that, all of the effort that goes into passing it, the difficulty level, that all goes to the public trust in the profession, which allows outside investors, outside interested people, whether that be potential stockholders, current stockholders, people that are loaning money, whatever the case may be, that gives those folks some peace of mind when they're going to look at the financial statements, that what the financial statements say is accurately representing what's going on with these entities. Okay? It's basically just an outline or a flow chart of what I was just talking about with the issues of principals and agents not having all of their incentives aligning with each other. Okay. So essentially, let me ask you guys this. Well, I won't ask because no one will answer truthfully. Let me just tell you an anecdote. Before I got into accounting, if you asked me what an auditor did, I would say that they went in, checked out the financial situation, and looked for any wrongdoing. Okay? I think generally that's the public, when they think of auditors, that's kind of the picture that they have in their head. Yeah, they're going to check out the financial statements, but I think a lot of people think audit, that means, hey, they're looking for not errors, but also, one of their principal things is looking for intentional fraud or things like that, right? It's true that auditors will obviously report on fraud if they see it. it's not true that the primary function of an auditor is to kind of catch wrongdoing. You're not a policeman per se as an auditor, okay? And the reason I bring that up is because a lot of people, maybe y'all have worked for an organization that had to be audited, but most people when they say, oh, the auditors are coming, they don't say that like, hey, my buddy, the auditor's coming. They're like, oh shit, the auditors are coming, we gotta get everything in order, right? Because they view the auditors as this kind of adversary, where they're coming in to find the mistakes that you've made. But in actuality, if you read your chapter and or ever work in the field, you see that it's the it's the business itself that went out and hired the auditors, right? The auditors are your friend, unless you're doing something, obviously if you're doing something illegal, then maybe they're not your friend. But if you've tried to do everything the right way, the auditors are coming in here and they're helping you, okay? They're not coming in. The goal of an auditor is not to issue an opinion that says your financial statements suck. That is not their goal. Every auditor, when they come in, what they want is to be able to leave saying everything is great. Why? Because guess what? Next year, when they want to get hired back, they have to come to you, who maybe the auditor just said, hey, their financial statements are not accurate at all. Well, if an auditor says that, what's the likelihood that you're going to hire them back next year? Right? The auditor is on the team of the company. And their main job is to say, look, the management has presented us with these financial statements, and we're going to issue an opinion as to whether these are accurately portraying what's going on in the business. So there are a lot of things come up when an audit is taking place that, if the auditor's only purpose was to screw you and find all your mistakes, there would be way more adverse and just negative audit opinions than there are. Because what usually happens, if they find something that you just messed up on, is they'll say, hey, correct this. Before we're done, correct this. That way we can say it's good. So, it's not like an auditor comes in and is grading you and says, okay, this is an F, we're giving a bad grade here. They're going to come in and they're going to do everything in their power to give you a good opinion, and at the same time, one that is accurate. Obviously an auditor can't come in and just lie, because if they issue a solid opinion that says everything's copacetic, and then next month you go out of business, and a bunch of investors invested money based on the auditor's opinion in these financial statements that turned out to not be correct, obviously an auditor is going to have some legal liability there. So auditors kind of have this bit of a challenging component to their jobs, in that the people that are negatively affected by anything other than a perfect audit are the very same people that hired them. So, they're very incentivized to not issue bad opinions. They will only do that if they have to. So, think when actually the fraud is uncovered, or if the financial statements are so bad that there's no audit adjustments that can get them correct in the amount of time necessary. Okay. Anyway, when management gives financial statements to the auditors, these are essentially, all of these assertions here are essentially what the auditor is checking for. Okay? For all these transactions, did they occur? Were they completely journaled the correct way? Were they authorized? How accurate are they? Were transactions cut off in the right time period? Beginning and ending balances of account balances. General presentation and disclosure. All of these things, the management is basically saying, hey, all of our stuff is good with respect to this, and then it's the auditor's job to come in, run enough tests to determine whether you can reasonably say that the management is correct in asserting these things. Okay? So these are not for this class per se, but when you talk about the CPA exam, these are the types of lists that you're going to have to memorize. Okay? It's going to ask you what are all the management assertions, and then you'll probably have some acronym figured out where you can think out in your head and list out all of these things. There's going to be a lot of similar type stuff to that on the CPA exam. Okay, so I haven't talked a lot about this yet, but the book is talking about auditing, attestation, and assurance. That's what this class is. Those are oftentimes kind of used interchangeably depending on the scenario. And so, you see there with the joined circles that basically any type of assurance service automatically includes an audit or a test or agreement. Okay, so audits and attestations are types of assurances. An audit is a type of attestation and a type of assurance. So these get less and less broad as you get smaller. Okay, and these are all three basically doing the same thing. Okay. All three of these engagements are basically someone hiring an accountant to come look at their books and give some measure of additional trust to the scenario. Okay? The main difference between these two is the level of trust that the accountant is saying you should give to their opinion. Okay? So under an audit, they're saying, hey, they're still not saying we're 100% sure this is right. We'll get into the language of these audit opinions, and you'll see that even the best audit opinion you can get only says, hey, we will give you reasonable assurance that these financial statements are free of material misstatement. Reasonable. So there's still a possibility that they're not, that you've done an accurate perfect audit, so to speak, but you've still missed something that would materially affect the financial statement. That's still possible. Okay? But auditing gives you if you hire someone to do an audit, that's the highest level of scrutiny that you're going to get. If an accountant comes out and does an audit, this means they're doing the most tests, they're doing the most samples, they're trying to give the most assurance that the financial statements are accurate. Attestation, you're doing the same types of stuff, but just not as much of it, and you're therefore, in your opinion, not giving as great amount of assurance. You're basically saying, hey, I'm reasonably sure that there's unlikely to be any material misstatements here. Okay? And then assurance would be, you're not even really going as far as saying, hey, I'm reasonably sure there's no material misstatements. You're just saying, hey, I'm an accountant, and because I looked at this stuff and I think it looks okay, it now is more trustworthy than what it was before. Okay? But, in my professional opinion, I'm still under this type of agreement or arrangement, or engagement, I guess I should say. I'm really not willing to go further than just saying, hey, I'm a pretty smart guy, I'm an accountant, and I think it looks good. That's pretty much all the assurance you're going to get from an assurance agreement. And then attestation and audit, I wouldn't say exactly stair steps up, but audit is definitely the most assurance that what you're seeing underneath is actually as it claims to be. So here's the book definition of auditing, attestation, and I'll put these slides up. I think I already did, actually, and assurance services. But like I said, these are all basically just three different flavors of the same thing, which is, hey, let's hire a professional, third party to come look at this stuff and give us a greater level of trust in the underlying material than we would have otherwise had. this is the basic flow chart of an audit. We will obviously go through this much more in depth as we go on. But again, this type of flow chart would be another example of one of the things on the CPA exam where it will actually ask you to follow through the flow. Okay. When we talk about financial statement audits specifically, there's kind of three underlying fundamental concepts that we need to understand. Okay? Materiality should be the easiest one to understand for y'all because we've talked about it in accounting before. Materiality in the realm of accounting and specifically with respect to financial statements just means any amount that you change in any category on the financial statements that's enough of a change to make whatever random decision maker change their decision. So think someone who's kind of on the fence whether to purchase this stock or not. Okay? And you change $5,000 one way or another in the financial statement, and that little change was enough to make your average decision maker decide to either buy or not buy the stock, then that amount would be considered material. Okay? So that's what materiality is. And if you look at the language, which like I said, we'll talk about more if you haven't read the chapter yet. But if you look at the language in the audit opinions, we very much like to use the word materiality or material when we are doing our audit letter. So we're basically saying, hey, if we do the audit well and we give an unqualified opinion, which is the highest level of audit that you can get, we're basically saying, hey, as CPAs, we are reasonably sure that the financial statements are free of material misstatements. So misstatements that are big enough that your average decision maker would change the way that they made a decision. If they get a clean audit opinion, which is an unqualified opinion, the best one they can get, that's still only giving outside users a reasonable assurance that the financial statements are free of material misstatement. Okay, so that's materiality. Evidence is obviously, it's an interchangeable to the everyday word evidence that you've heard, and it is just proof, right? All of those a few slides back that I listed all of those assertions that management is making about the financial statements. As an auditor, we want to go out there and look for proof of that either being true or not true. All the account balances, all of that stuff. When we go out and actually do audit tests, what we're looking for is proof or evidence, one way or another, about what's contained in these accounts, the history behind them, etc. Okay? And then finally, audit risk. That means as a CPA, what is the risk that I have done an accurate audit, competently performed my duties, and at the end of the day, I issue an unqualified opinion that says, I believe these financial statements, I'm saying these, I give reasonable assurance that these financial statements are free of material misstatement. Well, what is the chance that I've done that and there actually was a material misstatement there? Okay? Remember, all I'm saying is I'm reasonably sure there's no material misstatements. Well, given that I'm only reasonably sure, that means there's a chance that I'm wrong. Well, whatever that chance is my audit risk. The risk that I say everything's fine because I've done my tests and it actually turns out not to be fine. Well, how could that happen? Well, if anyone has, and again, this is stuff that as we go through the semester you'll see more, but if anyone's actually been through an audit, you know that auditors don't look at everything. They do what's called sampling. Okay? If they looked at every single thing, then there would be a whole lot less audit risk, but audits would be prohibitively expensive because you would take so many hours looking through all of these transactions. So you could perform a, by-the-book, exactly perfect by-the-book audit, and because we're sampling, we're only looking at samples of the transactions to try and figure out if everything's right, there is a chance that when we pick our samples, we've missed something that creates a material mistake. Okay? And that is what is called audit risk. So obviously, as someone planning the audit, we want to do our best to ensure that there's enough evidence that the risk that there's something material looming out there that I haven't caught as the auditor should be fairly low. Okay? Because obviously, in addition to just wanting to get hired back, as someone who's providing this level of trust to people, I'm legally liable for my audit opinion. If I issue an unqualified opinion, okay, and the reason that I ended up getting it wrong was just because I'm a slacker and I didn't do enough tests, I'm legally liable for that. So people could come sue me and I could basically get sued out of business because I ended up being wrong. So obviously as an individual auditor or working for a firm, obviously this might be out of your control, but the auditors are going to be the ones that say, this is all part of the process when audits get done, especially if you're having to bid on how much the audit's going to cost, is you have to take into consideration, hey, yeah, I want it to be as cheap as I can make it, but at the same time, if the audit risk is too high, then my risk of getting sued is too high. Okay, so it's always going to be kind of, even more so than accounting in general, it's going to be kind of a balancing act, so to speak. Audits. So it depends on what entity you're talking about, right? So there's no law that says every business has to be audited, right? If you're a publicly traded company, you have to get audited, quarterly, really, because they do financial statements quarterly. Actually, I think they do an audit once a year, and then they do 4 quarterly attestation agreements. But yeah, I mean, that's another thing to consider. How often are you going to do the audits, right? So that, depending on why you're doing them, that would be one thing that you would take into consideration in determining it. If you're a publicly traded company, you're just doing it because the law tells you, hey, you got to get audited, you got to do it this many times a year. So as a publicly traded company, it's pretty much out there for you. But, all the other companies that are out there, some of them will just never get audited because basically what an audit does is it says, hey, these financial statements are accurately prepared using GAAP financials. Okay? In the United States, as a CPA, you cannot issue an audit opinion unless the entity is reporting using GAAP financials. Okay? So if you have a cash basis entity, which a lot of small businesses are, and they're not reporting their financials on the accrual basis, you can't even do an audit, even if they wanted you to. Or if you did, someone would have to first go in and flip all their stuff from cash basis to accrual, and then you could go in and audit that. Okay? So if you're not required by law to get an audit, you still may decide to, for the same reasons we were talking about before, where there may be a third party that needs some extra measure of assurance that your financial statements are accurate. For instance, if you're a nonprofit and you're trying to go out there and get government grant money or funds like that, the government always wants you to go out and get an audit. Okay? So if you hadn't had one done before that, that might be where a lot of nonprofits first start getting audited. In addition to that, if you're not publicly traded but you are wanting to go public, obviously you would have to get audited there as a preliminary step. And then if you are just a cash basis business that just wants to go out and get a loan, you're much more likely, the bank's much more likely to give you a loan on the basis of your financial information if your financial information comes audited from a respected audit firm. Okay, so depending on the scenario, there's it could be multiple times per year, or it could be never that you get audited. We talked about what audit risk is and the fact that the audit standard only provides reasonable assurance of being free from material misstatement. When we talk about evidence that is gathered and collected in the audit process, these two R's, and I personally guarantee you that these two R's will come up at least once on the CPA exam. But relevance and reliability are kind of the buzzwords when we talk about evidence. Obviously, any evidence that we collect, if it's not reliable, we don't know if it's accurate or not. Obviously, it's not going to help very much. But then it also needs to be relevant to whatever it is that we're trying to test. So again, backing up to the slide that had all of those management assertions on it, you would go one by one through those assertions, and you would try to come up with evidence that reliably proves or disproves whatever management assurance there was. And that would be the relevance there. Like I said, pretty much never are you going to run into a scenario where as an auditor you're looking at every single transaction. Like all things related to accounting, that is a cost issue. You can almost always get more accounting information if you want it and are willing to pay the price, but as you get more and more information, it becomes less and less relevant. Again, because of this sampling concept, that's why basically kind of the other side of audit risk. Okay, the amount of, or the percentage of transactions we look at is probably going to be at least somewhat related to the amount of audit risk that we have. These are the 7 major phases of an audit. Again, this is ripe material for testing on the CPA. This is the crap they love to test about the audit section. Can you list out these various lists? So we've got, obviously, client acceptance or continuance. They got to hire you or hire you back for the next year. Preliminary engagement activities. That's just kind of red tape, essentially. Plan the audit. As a more senior person, this is going to be one of the key areas of the audit. Obviously, as a junior person, you're not going to do much of the planning. Let's see. Look at and audit internal control. Again, this is one of the additions to the auditing practice since Sarbanes-Oxley came about. We are now required to include this audit opinion on internal control. Then we go through and look at the various revenue and expense generating processes that the company has. Finally, completing the audit, and once that's done, or I guess that's probably more accurately completing the field work of the audit, not the audit itself, because the audit itself is not complete until the audit report is issued. So, memorizing those, even if you don't memorize the exact terminology, but if you can memorize those 7 phases roughly, that will help with future CPA prep. Once the audit report is issued, and we'll obviously go through all of these very in-depth, the various components of it, but those are the components of the standard audit report. Importantly, including the word independent in the auditor's report title, emphasizing the fact that, in theory at least, the auditor is supposed to be an independent third party. Unqualified, qualified, and adverse are the three categories of opinion. Obviously, like I said, unqualified being the best, or the one that says that I have the most confidence in the financial statements. And then qualified is basically when you say, hey, I have pretty good faith in this set of financial reports, except for this one component, or except for something that bothered me about the audit. So these are qualified basically mean, hey, overall it's pretty solid, but there's this one exceptional area that might be a troublesome area. And then adverse is basically saying, hey, this is what I'm seeing in the financial statements. I'm uncomfortable giving reasonable assurance that these are without misstatement, these financial statements. So that would obviously be the worst of those categories. And in fact, there's a fourth item that I would generally discuss here called disclaimer of opinion, where you're basically, the situation is bad enough, usually through lack of independence, but the scenario is bad enough, or the lack of independence is bad enough, that you don't even feel comfortable issuing an audit opinion. Okay, this sometimes also comes up when an auditor uncovers something that looks like pretty shady, maybe fraud going on, and says, hey, I need to take a look at these books that are hiding under your desk, and the management says, no, those ones are off limits. Okay? Something like that, where there's a bunch of red flags going off or something, but they will not let you see what you need to see to make an opinion, would be a scenario where instead of one of these three opinions, you would do what's called a disclaimer of opinion, where you just say, hey, because of this really funky issue, I want nothing to do with these financial statements. I'm washing my hands of it, essentially. I'm not going to spend a lot of time on the various reports right now, because we will go over those in depth later. Like I said, we've got adverse, qualified, and unqualified. And as long as you remember those right now, you'll be pretty solid at the moment. This is kind of going back to that other slide again, where we're just reminding you, hey, just because you either feel really confident or really unconfident about your accounting skills, that's not sufficient or all you need to succeed in auditing. You got to have logic, you got to have analytical ability, and you got to tie that to your accounting skills. Okay. Anybody have any questions? All right, that's it for the intro. First quiz is due Sunday. Let's see. I don't think I have anything else. Anybody have anything else they need to go over? All right, I'll see you all next week. Everybody sign this, yeah?